So a topic that comes up in the industrial market quite frequently is the question about sale-leaseback. How do they occur and why do they occur? So we're going to talk about that a little bit today. First off, a sale-leaseback for the company doing the sale-leaseback is a financing vehicle. Oftentimes companies in the industrial market, especially in the smaller format or 150,000 square feet and below format buildings, you see a significant volume of what we would refer to as owner users. That is to say, companies that both occupy but also own the building they occupy. Many times the opportunity will present itself that moving from an ownership to a tenant or leasing position is superior for the business. Now, why would this be? In the world that we're in today, with interest rate costs that have risen dramatically, we actually have, for the first time in many years, a condition where the financing alternative of sale-leaseback is superior to the borrowing options that a company might have. In other words, the borrowing rate for the leaseback or the cap rate is many times less than the corporate borrowing rate or the business borrowing rate for the enterprise. So in other words, if my borrowing rate is 10%, but if I could sell the building and lease it back at 8%, that's a 200 basis point spread and obviously a much more beneficial financing mechanism for the business than borrowing against their balance sheet. Another alternative, or at least an alternative use for the equity capital that's tied up in a building, is for business expansion. Many times the opportunity for the business is there to expand location or even make capital improvements to the facility they're in. But where will they find that capital? Oftentimes the solution is to sell the property, get the equity that was tied up in the property, and now redistribute that equity into the business options for expansion or business improvement or capital improvements that are on the table for that business. The company continues to control the asset as a tenant for as long as they want, whether it be a 5-year term, a 10-year term, a 15-year term, and whatever options might be built into that agreement. So it's a terrific way for a company to tap underutilized equity and either pay down debt, use it as a debt alternative, or use it to finance capital improvements designed for the business. So wrapping up the conversation for today, sale-leaseback is not a new discussion at all. It's been used by companies, big and small, for many, many years as a vehicle to expand business, pay down debt, or look at alternatives that the equity in a building can provide. The bottom line today is that interest rates have risen substantially, and this has opened up significantly the level of conversations that we're in today as a great source for alternative financing.